The next financial crisis isn't going to come from banks. It's not going to come from crypto, and it's not going to come from commercial real estate. It's going to come from something sitting quietly inside your 401k, wrapped in a label designed to sound boring on purpose. And that label is private credit. Because if you've been wondering why BlackRock, the largest asset manager on earth, has spent the last 2 years buying up private credit firms like they're going out of style, the answer isn't diversification, it's distribution. They need a new place to put your money before regulators catch up to what's actually happening. And to understand why this matters, you first have to understand what private credit actually is, because most people have never heard the term. And that's exactly the point. So let's rewind to 2008. After the financial crisis, regulators looked at banks and said, enough. Banks had been handing out loans to companies that had no business getting them, bundling that debt and selling it off as if it were safe. So Washington cracked down. New capital requirements, new leverage limits, new stress tests. And almost overnight, it became a lot harder and a lot more expensive for banks to lend to risky, mid-sized companies. But here's the thing about capitalism. If there's demand for money and banks can't supply it, somebody else will. And that somebody else was private credit. Private credit funds are basically non-bank lenders. Think of them as loan sharks in a suit, except instead of loaning to your cousin who owes money to bad people, they're loaning hundreds of millions of dollars to mid-sized companies that banks won't touch anymore. And unlike a bank loan, these deals aren't publicly traded, they're not rated the same way, and they don't show up on any exchange. They're negotiated privately between a fund and a borrower, which is exactly why it's called private credit. And for over a decade, this market grew quietly in the background, mostly used by pension funds, endowments, and insurance companies looking for higher yields than what bonds were offering. Here's how it actually works. Meet Sarah. Sarah runs a mid-sized manufacturing company that needs $200 million to expand. A bank looks at her balance sheet and says, no, too risky, too much leverage, doesn't fit our lending box anymore. So Sarah goes to a private credit fund instead. The fund says yes, but at a much higher interest rate, and often with looser reporting requirements than a bank would ever allow. The fund gets a fat yield, Sarah gets her cash, and nobody outside the deal ever really knows the terms. Multiply Sarah by tens of thousands of companies, and you've got a market that's ballooned from roughly $400 billion in 2010 to over $1.7 trillion today. Some estimates put it on track to hit $3 trillion within the next few years, and on paper, this sounds fine. Companies get funding, investors get yield, everybody wins. But the problem is what's underneath the hood, because private credit has 3 characteristics that should make anyone nervous. It's illiquid, it's largely self-valued, and it's now being marketed directly to you. Let's start with illiquid. Unlike a public bond, you can sell in seconds. Private credit loans can't be easily sold. There's no exchange, no order book, no easy exit. If a fund needs cash quickly, it can't just click sell. That's a problem for institutional investors who can lock up money for a decade. It's a much bigger problem for retail investors who might need their money next year. Then there's the valuation issue, and this is the part that should really concern you. Because when a stock trades on an exchange, its price gets updated constantly based on real buyers and real sellers. But private credit loans aren't traded, so their value gets marked based on internal models built by the same firms that issued the loans. Translation: the fund grading its own homework decides what its own assets are worth. And unsurprisingly, funds tend to mark these loans a lot smoother and a lot rosier than what the underlying risk actually looks like. There's rarely a sudden dramatic drop because there's no market forcing one. It's the financial equivalent of never stepping on a scale and telling everyone you haven't gained weight. Here's Nobel laureate and economist Robert Shiller on why illiquid, opaque assets are dangerous precisely because of how calm they look. Markets that don't have daily pricing create an illusion of stability that doesn't actually exist underneath. And that illusion is the entire selling point of private credit right now. Advisors market it as less volatile than stocks, when in reality, it's not less risky, it's just less measured. And this brings us to the third problem: distribution. Because for years, private credit stayed mostly locked away from regular investors. You needed to be an accredited investor, often with millions in net worth, to even access these funds. But that wall is coming down fast. And it's coming down because the largest asset managers on the planet need somewhere new to put money, now that public markets are more efficient and margins on plain old stock and bond funds keep shrinking. Which is exactly why BlackRock spent $12 billion acquiring private credit giant HPS Investment Partners, and why it's been pushing hard to get private credit included inside target date retirement funds, the default investment option in most workplace 401k plans. A quick pause, because this video is sponsored by Gamma. When I'm putting together a video like this, breaking down something as dense as private credit valuation models, the research gets messy fast. fast. Half-formed notes, contradicting reports, numbers scattered across a dozen tabs. Gamma is what turns that mess into something structured. I upload my research directly through Claude, connect the Gamma integration, and it builds a clean deck out of everything I've gathered. If I find new data later, it updates the deck automatically instead of me rebuilding it from scratch. It connects to GitHub, Notion, and Gmail too, so none of your research stays trapped as scattered notes. If you want to check it out, head to gamma.app or find it inside Claude connectors. Thanks again to Gamma for sponsoring this video. Now, back to why your 401k might be the next place private credit lands. Because in 2025, the Department of Labor issued new guidance clarifying that private assets, including private credit and private equity, could be included in 401k plans without automatically exposing plan sponsors to legal liability. That single clarification opened the floodgates. Because before that, most companies avoided putting illiquid, hard-to-value assets into retirement plans out of fear of getting sued if things went badly. Now that fear is mostly gone, and asset managers like BlackRock, who happen to now own massive private credit platforms, are perfectly positioned to be the ones filling that new demand. So think about the incentive structure here. BlackRock isn't neutral. They're not some outside party warning you about risk. They now own the supply, and they're lobbying for and building the pipes to get that supply into your paycheck-deducted retirement account, where you can't easily see the pricing, can't easily sell, and probably won't notice anything's wrong until it already is. And here's why the comparison to subprime isn't dramatic. It's structural. Before 2008, mortgage risk was hidden inside complex bundles, rated by agencies that were paid by the same banks issuing the debt and sold to investors who assumed safety because the rating said so. Today, private credit risk is hidden inside funds, valued by the same firms originating the loans, and sold to retirement savers who assume safety because a big brand name is attached. The packaging is different. The mechanism is nearly identical. And the warning signs are already showing up. Because when interest rates stayed elevated over the past few years, a lot of companies that borrowed from private credit funds started struggling to make payments. And instead of those loans getting marked down or defaulting cleanly, many got what's called payment-in-kind restructuring, where instead of paying interest in cash, the borrower just adds the unpaid interest onto the loan balance. Which sounds fine until you realize it means the debt keeps growing while the underlying company's ability to pay it back keeps shrinking, and the fund gets to keep reporting it as a performing loan the entire time. It's extend and pretend, dressed up in a prospectus. This is the part traditional financial media won't dig into, because it doesn't fit into 30 seconds. Nobody wants a headline that says opaque valuation methodologies in illiquid credit markets may be systematically understating risk. It doesn't trend. Instead, you get headlines like private credit offers strong yields for retirement savers, which is technically true and completely misleading at the same time. So here's the actual question nobody in the industry wants asked out loud. If these loans are as safe as they're being marketed, why do they need to be locked away from daily pricing in the first place? Why does the industry fight so hard against more transparent valuation standards? And why is the rush to get this into 401k plans happening right as growth in the traditional fee businesses is slowing down? Because when you follow the incentives instead of the marketing, the private credit boom stops looking like innovation and starts looking like the same story we've seen before, just with better branding and a decade longer to unwind before anyone notices. That's why I made this channel, because the risks that actually matter rarely come wrapped in a scary headline. They come wrapped in a pitch deck that says stable returns and lower volatility. So if you want to understand what's actually happening underneath the market before it becomes the story everyone's suddenly talking about, hit subscribe, because the next crisis is never the one everyone's watching for.